Matthew Circosta is an economist with Moody's. Matthew Circosta, thanks very much indeed for joining us. First of all, better than anticipated.
Yeah, look, after a couple of lean months, Aussie jobs bounced back in June, pretty much in line with our expectations. And it continues to suggest that the economy is robust and is recovering after a flood-induced weak first quarter. For us, with an unemployment rate hovering at 4.9% still, that really keeps pressure on the RBA to resume hiking rates. And so now our attention turns to the second quarter CPI report out later this month. And that will determine whether rates need to rise in August and whether additional hikes are needed later this year.
The thing is, the Aussie dollar and the strength that it has is doing some of the legwork for the RBA. So I put it to you that perhaps they don't need to, well, have another rate hike, and what they really perhaps need is to start looking at perhaps a rate cut. And when does the debate turn towards that?
Yeah, markets are certainly pricing in a rate cut over the near term. But we think that the dampening impact of the Australian dollar is a bit overstated at this stage, particularly if we see the US recovery pick up steam in the second half of the year, and that would put upward pressure on the US dollar and therefore downward pressure on the Australian dollar. So the central bank can't rely on the Australian dollar to do all its inflation-fighting pressure. More needs to be done on that front, particularly if the economy continues to add jobs like at this rate in the second half of the year.
But, Michael, supposing, we do get another rate hike, that's going to push the dollar up even higher here and make the economy less competitive, at least half of the economy, because we do have a two-speed situation.
Yeah, the two-speed worries are certainly prevalent, but if you note in the RBA statement, from its recent policy statement, it suggested that the two-speed worries are a bit unfounded. Not only are we having a strong mining sector, but we've also got... It also said that the services sector are expanding strongly, and they are expanding strongly because we've got this very low unemployment rate. So with this very low unemployment rate and wages growing as strong as they were just before the financial crisis, we're really starting to see strong domestic demand. And you saw that in the first quarter as well. Even though exports slumped and the economy contracted 1.2%, domestic demand remained very, very solid.
Well, does today's data in any way reflect what Wayne Swan's been talking about, saying that the strength of the dollar has been hurting manufacturing and also tourism?
Yeah, certainly some sectors are performing a bit weaker than the average, but from a macroeconomic perspective, the economy is in a very healthy position. Retailers are feeling the pinch a little bit. The tourism sector with the high dollar is feeling the pinch a bit, but looking at it from an aggregate level, everything seems to be running smoothly, and that's what the RBA is really focused on. They can only set monetary policy at the macroeconomic level, and on that front, everything seems to be going well.
Yeah, I guess we also have to look at where these jobs are being created as well, on the East Coast or the West Coast, in the commodity side of things.
That's right.
We don't know that just yet, do we?
Well, there is a state breakdown with the data, and from what I've found is that certainly Western Australia is performing very strongly, and you would expect that given the mining boom they're facing. But unemployment rates in the service sector states, such as New South Wales and Victoria, are still below their averages from 2010. So that continues to suggest that domestic demand remains solid, even though some sectors are performing a bit lower than the average.
Michael Circosta, thanks a lot for joining us. Michael Circosta from Moody's.